Hello and welcome back to All Things Money. I'm your host, David Blain. During this final segment of today's show, I was going to cover what I call one of my investing philosophies, which is, the way to make money is really to focus on how not to lose money is, 75% of the game. I think we're going to wait, sort of a teaser, have you tune in again next week, probably take the whole show to talk about that. So we're going to talk about a few other things during this segment. Number one, which is just fascinating to me, our firm about 5 years ago, we converted to all exchange-traded funds. We don't use mutual funds, and we no longer use individual stocks or bonds, things like that. And there are multiple reasons for that I don't want to get into today, but we're a big advocate of ETFs as an appropriate way to build a portfolio. Now, we're talking about the core ETF. I mean, they're coming out with all kinds of crazy stuff today, these leverage products, and that's not what we're talking about. We're talking about getting your exposure to, say, the U.S. Equity market through an exchange-traded fund. Well, anyway, so it looks like for the first time the trading volume of the exchange-traded funds that track the U.S. stock market have exceeded the volume of the actual securities themselves. And the reason I bring that up is to people that aren't paying attention or that are still very skeptical of your core ETFs. I mean, you're missing the boat. The majority of money management, the majority of people are recognizing that trying to pick individual securities, especially in your large liquid markets such as the U.S. large cap market, is very difficult to outperform a passive index of those investments. Now, it's not to say institutions and individuals are still out there. They're still buying individual stocks. There's still tremendous volume, Apple and Exxon and things like that. But the point is that the rise of the exchange-traded fund is something to be aware of. And in fact, our philosophy is what we call a global macro, meaning that we look for exposure to different asset classes, U.S. large companies, European large companies, Japanese companies, Chinese companies, the bond market, emerging market bonds, commodities, currencies, these what we call macro asset classes, and we move money or overweight or underweight these big asset classes depending on what the economics are going on in the world, what psychology, bubbles, depressions, things like that, will move money amongst asset classes. This is in contrast to people that are trying to pick individual companies that are saying, well, I think Coke is better than Pepsi. And so what we're seeing is this macro thing. People are realizing that, gosh, the U.S. economy as a whole is going to affect all companies. Even if you've got a great company, it's very difficult for that company to withstand the overall economic pressure of the stock market as a whole. So you see that it becomes more and more difficult for what we call stock pickers to beat those markets. And we see that more and more people, the money is moving around in the world based on these macro type themes. Is China growing faster than Europe? Is Europe collapsing? Things like that. And you see big money moves, not necessarily overnight, but a gradual shifting of money. You see a big flow right now into the bond market, and a lot of that is facilitated. It's very easy. It's very cheap to do it using exchange-traded funds. A lot of the providers, we custody our clients' money at Schwab Institutional, and a lot of the ETFs we use they're free. They're free to trade, and the annual expense ratio is extremely minimal. So to move, let's say you have 30% in U.S. markets and 20% in foreign markets, and based on what's going on in the world, you think that the European markets are going to have trouble for a long time. Well, in one simple transaction, you can shift 10% from European markets over to U.S. markets. If you had 20 or 30 different European companies and 20 or 30 different U.S. companies, to make that shift is very difficult. So you see that the ETFs are perfectly suited for what we call macro trading. And so I think you're going to continue to see, as globalization continues to take hold around the world, you're going to see that ETFs, the core ETFs, the one that give people exposure to the broad asset classes, you know, the stocks, bonds, commodities, currency, are going to continue to accumulate trading volume, and you'll see fewer and fewer people trading in individual securities. Now, for those of you brave enough, I was reading something the other day that some of the stock pickers think that's a great opportunity for them, because as few and few people are looking at those opportunities, they feel like some opportunities will open up for them. I still think that the macro factors for the foreseeable future are going to swamp the individual fundamentals of any given company. A couple days ago, you may or may not have heard about Knight Capital, and I don't want to go into all the details, but Knight Capital is a prominent player in trading on Wall Street, and they had all sorts of problems with their software, and people are using that as an excuse to get out of equities again, and I think that's a very superficial thing. As I mentioned with the ETFs, we see a lot of macro trading going on, and people are moving away from equities. You know, they're just discouraged. The past 10, 12 years, they haven't been making a lot of money, and they're really flooding into the bond markets. And we see that you know, Bill Gross of PIMCO, he's the largest bond fund manager in the world, you know, said that, you know, the cult of equities is dying, that people are losing faith in the long-term viability of equities. And I think, you know, that's true to some extent. Somebody that thinks that they can just buy and hold, you know, equities, that sort of era, what we saw between 1982 and 2000 was very, very unusual, and it's probably not going to appear again. Especially in the United States, we had a combination of, we had a very large middle class, the boomers. That's where all the spending comes in. They didn't have a lot of kids, so you had a small youthful population, which tends to draw money out of the economy. And you had a small population, the parents of the boomers was relatively small. They lost a lot of people in World War I, and so there wasn't the large demographic. So you had this perfect storm of, you know, low inflation, a booming GDP that spawned the bubble of 1982 to 2000. I just don't think you're going to see that return, and people are recognizing it. I think there's still money to be made in equities. You just can't sort of buy, hold, and bury your head in the sand. Okay, well, that brings us to the end of today's show. I hope you enjoyed it, and hopefully next week we'll get into my rule on focusing on how to not lose money in investing. So for All Things Money, I'm your host, David Blain. We'll see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.